So here's what we're seeing in the news today. We have Fed official Waller. He sits on the Federal Reserve. Now, he's one of the candidates that the president is maybe targeting to be the next Fed official. Here's what he's saying down through here. He's saying that the Federal Reserve at the next meeting he argues that the Fed policy rate should be 3%, which is 125 to 150 basis points higher than where it is, okay? Or lower than where it is. So 125 to 150 basis points, what that means is 1.25% to 1.5%. So quite a bit of a drop there. Let me explain it to you how it works. So here's what the Federal Reserve monitors, okay? They look at inflation numbers, they look at the unemployment numbers, and they also focus on GDP. But here's the rate that they control. Well, here's what Waller's saying. He's saying, well, inflation, let's say inflation's on the high end. It's at 3%. So this federal funds rate should be pretty much equal to what the PCE or the inflation rate is. Well, it's not. It's way inflated. So that's why he's saying there could be at least 125, maybe 150 basis points pulled out of here and still not affect the market because we're still not with that equilibrium point of where inflation is or what the number they track is. So that's what he's saying. He says, if we track inflation by the PCE and it's 2.3 and we're holding our rate at 4.25, it's way inflated. And that is what creates this thing over here. Now, this is the yield curve. This is how interest rates work. And here, how it should work, it looks something like this. Let's go back in time a little bit. And here's what's called the yield curve. And you might hear people say, well, there's an inverted yield curve and the yield curve is flattening and so forth. But here's what a yield curve should look like. Okay. In the front end, meaning short-term maturities, if you're looking at a 1 month or 2 month investment, you should get really low returns because you're only holding up your money for a short duration of time. As you go on in time, you should get higher and higher returns. Well, here's the problem. If you go over to this and see what the yield curve looks like today, it's up here. And this is higher than where we are in the 7-year bond market. So the Fed and everybody's saying, Fed, you need to drop this considerably down to here to at least flatten this thing out and make it a normal yield curve. So that's his argument there. And I'd have to say I would agree with it. Even if the tariffs come in at the high end, we're not going to see a 1 to 1.5% increase in inflation that I know of. And no economist is saying we are. Okay, so let's get to the next piece of the puzzle.